Have you ever looked at a company's financial report and seen like incredible revenue growth, only to then find a kind of puzzling dip in their profitability? What does that really tell us about their strategy and, their future? Welcome to the deep dive. Today, we're going to try and cut through the complexity of the recent financial report from Progress Software Corporation. This is for the quarter ended May 31, 2025. And just so you know, our entire deep dive, it's based directly on their detailed SEC Form 10Q filing. So you're getting an unvarnished look. Our mission here is to strip away the jargon, pull out the most important insights, and really understand what Progress Software's recent bold moves, especially that massive acquisition, what they truly mean for their business, and what ripples it might send through the broader tech landscape. By the end of this, you should have a clear, informed picture of how a major software company navigates both, well, ambitious growth and some significant challenges. So let's unpack this. Okay, so at first glance, the top line numbers are, well, they're incredibly impressive. We're talking really significant revenue growth here. For the 3 months ending May 31, 2025, their total revenue soared to nearly $237.4 million. That's a whopping 36% jump from last year.
Huge jump.
Yeah. And over the 6 month period, revenue was up 32% to over $475 million. Now, this growth is clearly, undeniably propelled by the ShareFile acquisition. But here's the fascinating twist. While revenue surged, their net income for the 3 months was only up a modest 5%, just over $17 million.
Right.
And for the 6 month period, it actually decreased by a notable 28%, dropping to around $28 million. That's quite a contrast, isn't it?
It absolutely is. And what's fascinating, like you said, is precisely that dichotomy. You've got massive revenue growth on one hand, but then a significant hit to the bottom line on the other, especially when you look at that longer 6-month view. It tells us the ShareFile acquisition, while definitely boosting their top line, isn't just, adding revenue. It's had a complex and substantial financial impact. And it immediately makes you ask about the costs. Right, the costs of integrating such a large new asset. It's that classic growth versus profitability challenge playing out.
Yeah. Growth at what cost? So when we break it down then, how has this big acquisition fundamentally shifted how Progress Software actually makes its money? What did you find when you dissected their revenue streams?
Well, the picture gets even clearer there, actually.
Yeah.
If we look at their sort of traditional software licenses, they actually saw a decrease.
Oh, really?
Yeah, down about 6% for the quarter to roughly $50.8 million. This meant software licenses' share of total revenue for the quarter. It shrunk from nearly a third down to just over 1/5. They even specifically mentioned a decrease in their data direct product offering.
Okay.
Maintenance revenue, which is usually pretty steady for them, remained relatively flat, around $103.5 million for the quarter.
Okay, so licenses down, maintenance flat. But then you hit the SaaS revenue, and that's where the charts must have just gone vertical, right?
Exactly. That's the real story. The true standout in their revenue mix is the explosion in SaaS. For the 3 months, it hit over $72 million.
Wow.
Which is a staggering 1,104% increase.
1,000%.
Yeah. And for the 6 months, it's up over 20%. This monumental jump is almost entirely because of the ShareFile acquisition. It completely reshaped their revenue portfolio, you see, pushing SaaS's proportion of total revenue from just a tiny 3% up to a dominant 30%.
That's incredible. A complete shift.
It really is. And on the flip side, professional services saw a bit of a dip, down about 13% for the quarter. They mentioned that was partly due to some changes with their MarkLogic offering.
Right, okay. That makes sense. That is a massive shift in their business model right there. And geographically, where did we see the biggest impact from this acquisition? Was it spread out or?
Overwhelmingly North America. It saw the largest revenue increase by far, up more than $44 million for the quarter alone.
$44 million just from North America.
Just in the quarter, and about $91.8 million for the 6 months. Again, thanks mostly to ShareFile. Now, non-North American markets also grew, increasing by roughly $17.9 million for the quarter. So it's not only North America. But it shows that while ShareFile was global, its most immediate, biggest impact was felt domestically.
Okay. So that significant revenue growth from ShareFile, it obviously didn't come without a corresponding increase in costs, right? Both operational and financing. It sounds like they're paying a pretty penny for this strategic growth.
Okay.
What stands out to you as the biggest cost drivers here?
That's absolutely right. The big revenue numbers are, well, they're balanced by some equally big increases in expenses. You look at their cost of revenue first for maintenance, SaaS, professional services. That jumped by over 50% for the 3 months.
50%.
Yep. to roughly $33.8 million. And this was driven primarily by increased hosting costs and a larger workforce directly related to ShareFile. More people, more servers.
This makes sense.
Then their operating expenses also surged across the board. Sales and marketing costs up 31% to almost $50 million.
Wow.
Product development expenses also rose 31%, nearly $46.6 million. And general and administrative costs were up 17% to over $25.6 million. All of these, the report ties directly back to integrating ShareFile.
So a bigger company just means bigger operational costs across the board. That tracks. But what about the maybe less obvious costs that come with such a large acquisition? Anything hidden in there?
You hit on a crucial point there. Perhaps the most impactful figure we need to explain is the amortization of acquired intangibles.
Right, the intangible assets.
Exactly. You can think of this as the company slowly expensing the value of the non-physical assets they bought with ShareFile, things like customer lists, brand names,
Yeah.
maybe specific software patents. That line item alone jumped a massive 60% for the 3 months.
60%.
Yeah, to over $26 million.
Right.
Directly reflecting the value of those intangible assets from the ShareFile deal. It's a big non-cash expense, but it hits the income statement hard.
Yeah.
But the key driver, and this is really important, the key driver behind that 6-month net income decline we talked about right at the start, that's a massive increase in interest expense.
The financing cost.
Precisely. It ballooned to over $18.1 million just for the 3 months. That's an astonishing 159% increase compared to last year.
Wow, 159%.
And for the 6 months, it was up 155% to more than $36.5 million. The report explicitly states this is a direct result of them drawing on their revolving line of credit, basically a flexible loan to fund that $875 million ShareFile acquisition.
$875 million. That explains the interest.
It's a significant debt burden they've taken on, and you see it directly impacting the bottom line.
Okay, that's a huge increase in interest payments. What other costs came with actually, integrating ShareFile, the messy stuff?
Right, the integration costs. We also see a significant jump in restructuring expenses. These were up 60% for the quarter and, get this, over 169% for the 6 months.
Whoa.
These costs are directly related to integrating ShareFile. And they often involve, the difficult things like headcount reductions, consolidating facilities, basically the nuts and bolts of streamlining a merged company.
The painful side of M&A.
Exactly. And finally, you also see acquisition-related professional service fees, think legal bills, consulting fees, they also increased notably, up over 200% for the quarter to about $1.7 million. Again, all tied to getting the ShareFile deal done and integrated.
So it's clear ShareFile is the dominant theme here, financially speaking. But beyond the acquisition and its immediate impact, there's another ongoing situation that's important for Progress Software, the MOVEit vulnerability. Now, this is a major cyber incident for them last year. What does their latest report tell us about its ongoing financial impact? Is it still a big drag?
Well, I guess the good news on that front is the direct financial costs they incurred related to the MOVEit vulnerability have significantly decreased.
Yeah.
They were about $7.7 million for the 3 months and $1.5 million for the 6 months, which is notably down from $3 million to $4 million respectively from the same periods last year. So a big drop.
That's a positive trend. And crucially, how much of that is being offset by insurance? Are they getting recoveries?
Yeah, a good portion, actually. These costs are reported net of insurance recoveries, meaning they recouped about $0.6 million for the 3 months and $1.3 million for the 6 months from their insurers.
Okay, so the net cost is pretty low right now.
Relatively low, yes. And they mentioned they still have about $5.4 million remaining on their cybersecurity insurance coverage, which is also positive, provides a cushion. However, and this is big however, this raises an important question. While the immediate direct costs are down in managed with insurance, the report explicitly states they cannot reasonably estimate a range of possible losses from the ongoing legal matters. Specifically, the class action lawsuits, which are now centralized, and various government inquiries.
So the legal fallout is still very uncertain. They can't put a number on it.
Exactly. The lawsuits are still in early stages. Motions to dismiss have been filed, but there's no resolution. The government inquiries are also ongoing.
So even with the current costs looking manageable and insurance still available, there's still this sort of hanging uncertainty, especially on the legal front. Why is that specific unquantified risk so crucial for a software company like Progress?
Well, it's vital because, for a software company, trust and security are absolutely foundational. bedrock stuff.
Right.
An inability to quantify potential losses from legal proceedings or government inquiries means there's this open-ended risk. It's not just financial. It's a risk to their brand, reputation, potentially customer churn, maybe even future contract negotiations. So while the immediate financial liability might seem contained or covered by insurance for now, the broader impact on their market perception, their ability to secure new business, that could be significant and far-reaching. It's a risk that could affect long-term growth, even if the immediate financial hit is ultimately manageable.
That makes sense. A cloud of uncertainty. Okay, so with all these strategic shifts and financial movements, the huge acquisition, the rising costs, the debt, and these lingering cyber issues, what does their actual cash situation look like? And what are their plans for the future? How are they managing their liquidity through all this?
Right, the cash picture. Well, their cash and cash equivalents did decrease. They dropped to about $102 million at the end of May, down from roughly $118 million at the end of November 2024.
Okay, so cash is down a bit.
Yeah. And when we look at cash generated from operations, the cash they make from their actual business, that also decreased for the first 6 months. It was about $98.9 million compared to over $134 million last year.
And that's mainly the interest payments biting.
Primarily, yes. The report points directly to that significant increase in interest expense tied to the ShareFile financing as the main reason for lower cash from operations.
So less cash coming in from operations because of the debt payments, but did they at least use some cash to pay down some of that debt?
They did, which is definitely a positive signal. They repaid $70 million on their revolving credit facility during the first 6 months.
Okay.
And this next strategic move is, well, it's a major signal for anyone following corporate strategy. Progress Software's board of directors approved the suspension of their quarterly dividend back in September 2024.
Suspending the dividend. Wow. That's a huge move for a publicly traded company, isn't it? What does that signal about their priorities, their capital allocation strategy?
It's a very clear and quite deliberate strategic pivot. It wasn't just some random cut. The report explicitly states it was specifically to redirect that capital.
Redirect it where?
Towards aggressive debt repayment, funding potential future mergers and acquisitions, and also share repurchases. It tells you loud and clear they're prioritizing financial flexibility and strategic growth over returning cash to shareholders via dividends, at least in the short term.
Paying down debt and looking for the next deal, basically.
Seems like it. They want that flexibility.
And speaking of share repurchases, are they still doing those even though they cut the dividend?
Yes, they are. They repurchased about $50.1 million worth of their common stock in the first 6 months of the fiscal year. That includes $20 million just in the most recent quarter.
Okay.
And they still have about $57.2 million remaining under their current share repurchase authorization. So that's still active. Despite the overall cash decrease and a dividend suspension, the company states in the filing that they believe their existing cash, the funds they generate from operations, and their available credit line will be sufficient.
Sufficient for what?
Sufficient to cover their needs for at least the next 12 months. That includes planned capital expenditures, potential acquisitions, those mandatory debt repayments, and other obligations. They also mention they're actively evaluating additional financing options, which indicates they're, keeping their options open for future needs, whether that's for general corporate purposes or maybe even accelerating debt repayment further.
Okay. So to kind of bring it all together for you, Progress Software is clearly in a period of really intense strategic transformation, and it's overwhelmingly driven by that ShareFile acquisition. You've seen how this acquisition has fueled significant top-line revenue growth, especially in that crucial SaaS segment. That part looks great on the surface.
Right.
But you've also seen how it has profoundly impacted their cost structure, significantly increased their debt load, and crucially led to that major shift in their capital allocation policy, including the suspension of their dividend.
It's truly an intertwined story, isn't it? It's a company prioritizing strategic growth and aggressive debt reduction. The increased revenue from ShareFile comes hand in hand with higher operating expenses, substantial interest payments on the debt they took on for the acquisition, and that very clear strategic decision to suspend dividends. It's a company making deliberate, pretty bold moves to reshape its financial future and presumably its competitive position.
Absolutely. This deep dive really shows a company betting big on its future, making some tough choices along the way. Now that you understand the financial mechanics behind these decisions, maybe consider this. How might these aggressive capital allocation choices, specifically suspending the dividend and that intense focus on debt repayment, potentially for more M&A, how might that shape Progress Software's competitive position and its long-term financial stability, especially in this, rapidly evolving AI-powered application space? What might you expect to see in their very next report that either confirms or maybe challenges this strategy? Something to think about. Until next time.